Miss your required minimum distribution deadline, and the IRS automatically takes 25% of whatever you should have withdrawn. Not a warning, not a letter, a penalty. Applied immediately. Stay with me because in the next 10 minutes, I am going to walk you through exactly how RMDs work in 2026 when you must start taking them, how to calculate yours, and 4 specific strategies that can significantly reduce what you owe in taxes. Let's go. Every dollar you put into a traditional IRA, a 401k, a SEP or most employer retirement plans came with a tax deal. The IRS let you skip the tax on the way in, on the understanding that it would collect on the way out. A required minimum distribution, or RMD, is how the IRS collects. Starting at a certain age, the government requires you to withdraw a minimum amount from those accounts every year and pay ordinary income tax on it, whether you need the money or not. The amount is not a fixed number. It is calculated based on your account balance and your life expectancy according to IRS tables, and missing the deadline has consequences. In 2026, the answer depends on when you were born. If you were born between 1951 and 1959, your RMDs begin at age 73. This is the rule under the Secure 2.0 Act passed in 2022. If you were born in 1960 or later, your RMDs begin at age 75. This higher starting age was also established by Secure 2.0 and takes full effect starting in 2033 for those birth years. There is one important first-year exception. For your very first RMD only, you can delay the payment until April 1st of the year after you turn your RMD age. So if you turn 73 in 2026, your first RMD does not have to be taken by December 31st, 2026. You can wait until April 1st, 2027. But here is the catch. If you delay your first RMD to April 1st, you must still take your second RMD by December 31st of that same year. That means you take 2 taxable distributions in 1 calendar year, which can push you into a higher tax bracket. Many financial planners recommend taking the first RMD in the year it is due rather than delaying for this reason. The formula is straightforward. Take your account balance as of December 31st of the prior year and divide it by the distribution period that corresponds to your age from the IRS Uniform Lifetime Table. For example, if you are 75 years old in 2026 and your account balance at December 31st, 2025 was $500,000, your distribution period from the IRS table is 24.6. Dividing 500,000 by 24.6 gives you an RMD of approximately $20,325 for 2026. If you have multiple traditional IRAs, you calculate the RMD separately for each account, but you can withdraw the total combined amount from any one or any combination of those IRAs. You do not have to take a separate withdrawal from each account. For 401k plans and other employer-sponsored plans, the rules are different. Each plan requires its own separate withdrawal. You cannot aggregate employer plan RMDs the way you can IRA RMDs. Roth IRAs are completely exempt from RMDs during the original owner's lifetime. And as of 2024, Roth 401k accounts are also no longer subject to RMDs. This is a significant change from prior rules and one of the most valuable features of Roth accounts in retirement. For all RMDs after your first one, the deadline is December 31st of each year, not April 1st, December 31st. This is a hard deadline. There are no extensions. If December 31st falls on a weekend, you need to complete the withdrawal before the markets close on the last business day of the year. Many financial institutions see a significant rush of RMD withdrawals in December. If you wait until the final days of December, you risk processing delays. The better practice is to set up automatic distributions earlier in the year, or take your RMD in the first quarter when you can give it your full attention. The 25% penalty outweighs and how to reduce it. If you miss your RMD or take less than the required amount, the IRS imposes an excise tax of 25% on the amount you failed to withdraw. On a $20,000 RMD, that is a $5,000 penalty on top of the income tax you still owe on the distribution. However, Secure 2.0 reduced this penalty from the prior rate of 50% and added an important correction window. If you correct the missed RMD within 2 years, the penalty is reduced to 10%. This is still significant, but far better than the previous 50% penalty. If you miss an RMD, the IRS requires you to file Form 5329 with your tax return. You can also request a penalty waiver by demonstrating that the failure was due to reasonable error and that you are taking steps to correct it. Many first-time errors are waived entirely when properly documented. If you have inherited an IRA from someone other than your spouse, the rules changed significantly in 2020 under the Secure Act, and 2026 is when the strictest interpretation of those rules takes full effect. Most non-spouse beneficiaries must now empty an inherited IRA within 10 years of the original owner's death. And here is the part many people do not realize. If the original IRA owner had already reached their required beginning date before they died, the beneficiary must also take annual RMDs during each of those 10 years, in addition to emptying the account by year 10. You cannot simply wait until year 10 and take the full balance. Inherited Roth IRAs are also subject to the 10-year rule, but with no annual RMD required along the way. You just need to empty the account within 10 years. The penalties for getting inherited IRA distributions wrong are real, and the rules are complex. If you have inherited a retirement account, this is one situation where working with a CPA or estate planning attorney is worth the investment. 4 strategies to reduce your RMD tax burden. Strategy 1: qualified charitable distributions. A qualified charitable distribution, or QCD, is one of the most tax-efficient tools available to retirees who are charitably inclined. If you are age 70 and a half or older, you can transfer money directly from a traditional IRA to a qualified charity, and that transfer counts toward your RMD but is never included in your taxable income. The limit in 2026 is $111,000 per person per year. On a $20,000 RMD, using a QCD instead of a regular withdrawal saves you the income tax on that entire amount at a 22% tax bracket. That is $4,400 in federal tax savings on a single distribution. Strategy 2: Roth conversions before RMDs begin. If you have not yet reached your RMD age, converting some of your traditional IRA to a Roth IRA in lower income years permanently removes that money from future RMD calculations. A smaller traditional IRA balance means smaller future RMDs and lower taxable income throughout retirement. The conversion itself is taxable in the year it occurs. The strategy works best when done incrementally during years when your income is lower than it will be when RMDs begin. Strategy 3: reinvest what you do not need. An RMD must be withdrawn, but it does not have to be spent. If you do not need the money for living expenses, you can reinvest it in a taxable brokerage account. The money continues to grow just in a taxable account rather than a tax-deferred one. Strategy 4: coordinate RMDs with Social Security and Medicare planning. RMD income counts toward provisional income for Social Security taxation and toward the income thresholds for Medicare IRMAA surcharges. Taking large RMDs can push you into higher Medicare premium brackets, which take effect 2 years after the income year in question. Working with a financial advisor or CPA to coordinate the timing and amount of RMDs with your other income sources can meaningfully reduce your total tax burden in retirement. Required minimum distributions are not optional, and the deadline is real. But with the right strategies, they do not have to be as painful as they sound. Know your RMD age, calculate your amount, set up automatic distributions early in the year. Consider a qualified charitable distribution if you give to charity. And if you have inherited a retirement account, get professional guidance before the 10-year clock runs out on you. If this video helped clarify something you had been confused about, please share it with someone approaching retirement age. Subscribe if you haven't already, and I will see you in the next video. Stay safe and stay protected.